There's a kind of magic in the world of finance. Not the sleight of hand kind, but a high-tech, data-driven magic that's changing everything we thought we knew about the stock market. For decades, investors relied on gut feelings, human intuition, and old-school analysis. But now, there's a new player in town: artificial intelligence. And it's not just assisting humans, it's making predictions that rival seasoned traders. So, how exactly does AI predict stock prices? What goes on under the hood of those complex algorithms that claim to know where the market is headed? And should you trust them? Let's dive deep into the fascinating world of AI in stock market forecasting, exploring the techniques, technologies, challenges, and controversies behind this digital revolution. To start, let's break down a very important idea. AI doesn't actually predict the future. It forecasts based on patterns in data, patterns most humans could never spot, no matter how many charts they stare at. The more data you feed into the system, the more refined those patterns become. It's like teaching a machine to see the market not as random noise, but as a symphony of trends, signals, and movements. The backbone of AI in stock prediction is machine learning, a subset of artificial intelligence where systems learn from data. The machine is fed historical stock prices, financial indicators, news articles, social media sentiment, earnings reports, and even global economic trends. It processes all of this, identifies patterns, and uses that knowledge to predict how stocks might behave in the future. But machine learning is a broad field. There are several approaches within it that power stock market predictions. One popular method is supervised learning. In supervised learning, you provide the AI with inputs and known outputs. For example, input might be a set of technical indicators from previous trading days like moving averages, volume, RSI, and momentum. The output is the actual stock price on a future date. The algorithm keeps adjusting its internal parameters until it can accurately map input to output. Once trained, it can take new input data and make predictions. Then there's unsupervised learning, where the AI tries to make sense of data without predefined labels. This is useful for clustering stocks into groups with similar behavior or detecting anomalies like sudden spikes in volume that don't align with normal patterns. These anomalies can be red flags or hidden opportunities. Another powerhouse in AI-driven predictions is deep learning. This is where things start to resemble science fiction. Deep learning uses artificial neural networks that mimic the human brain. These networks consist of layers: an input layer, multiple hidden layers, and an output layer. The more layers, the deeper the network. These systems can capture incredibly complex relationships between inputs and outputs. A well-known deep learning model used in stock forecasting is the LSTM, or Long Short-Term Memory Network. Unlike traditional models, LSTMs are designed to handle sequences and time series data, which makes them perfect for analyzing stock prices over time. LSTMs can remember long-term dependencies, like how a stock's behavior last month might influence today's movement. Now, let's talk about the data, because without data, AI is like a car without fuel. The first 10 most obvious type of data is historical stock data. This includes opening price, closing price, high, low, volume, and other technical indicators. It's the bread and butter of quantitative analysis. Then comes fundamental data: financial statements, earnings per share, revenue growth, debt levels, and more. This helps the AI understand the intrinsic value of a company. But what about the human element? That's where sentiment analysis comes in. AI models can now scrape and analyze text from news articles, social media, press releases, and even Reddit forums. Using natural language processing (NLP), the AI gauges the overall sentiment: positive, negative, or neutral, and incorporates this into its prediction. If a CEO tweets something optimistic or a breaking news story suggests political instability, the AI factors that in, often within seconds. And let's not forget macroeconomic indicators: interest rates, inflation, GDP growth, employment data. These can significantly affect entire sectors and indexes. A smart AI model will consider these broader trends when making its calls. Now that we know what goes into the AI brain, let's explore what comes out of it. AI predictions typically fall into two categories: regression and classification. In regression, the model predicts a continuous value, like forecasting that a stock will be priced at $105.50 tomorrow. In classification, the model predicts a category, like whether the stock will go up, down, or stay the same. Traders use both depending on their strategy. Some systems go even further, recommending trades, setting stop-loss levels, and dynamically rebalancing portfolios based on real-time data. This is the realm of algorithmic trading, where AI doesn't just predict but also acts. The entire trade cycle from prediction to execution is automated. This is what powers high-frequency trading firms, which make millions by executing trades in milliseconds. Now, before you rush off to build your own AI trader or sign up for an AI-driven investment app, it's worth taking a pause. AI in stock prediction is powerful, but it's far from perfect.